Hello and welcome to the Global View on this Friday. Well, US Treasury yields are in something of a holding pattern as the market waits for tomorrow's US non-farm payrolls report. The 10-year yield at 4.14%, that's after falling as low as 4.1 on Wednesday, the lowest in fact in 3 months. And the 2-year yield down to 4.57%. Now those yields have tumbled on concern about slowing US economic growth. Meanwhile, the number of Americans filing new claims for unemployment benefits increased moderately last week, suggesting that the labour market is gradually losing momentum. And potentially weighing on US government debt longer term are hints that the Bank of Japan could move away from its ultra-dovish policy, with an increase in Japanese government bond yields making US debt relatively less attractive. And the Japanese yen has surged against the US dollar on the prospect that the Bank of Japan policymakers could lift interest rates. The Aussie dollar trading at 66 US cents. Well, will financial markets make a comeback in 2024? Jim Caron is the Chief Investment Officer of Portfolio Solutions at Morgan Stanley Investment Management. He says perhaps it's time for the broad financial asset markets to uniformly perform well and make a comeback. Let's hear why.
The reason why it makes sense is that we have to think about the inflation component of all this and a concept called R star, which is the real Fed funds policy rate, but it's the equilibrium rate, which is why they call it R star. That's the level of policy rates that balances full potential growth and inflation. So effectively, if we think that inflation, for example, is coming down to 3% on average, with the Fed funds policy rate in the US at 5.5%, what that means is that we have a 2.5% real policy rate. That's the nominal rate minus 3% inflation. And what we think the Fed is considering to be neutral is more like 1.5%. And so that's saying that with inflation coming down, the Fed needs to adjust its nominal policy rate lower just to keep the same level of tightness in the markets. So it's another way of saying that with the expectations for the markets for the Fed to cut interest rates 100 basis points, that's really just the Fed staying, relatively where they are right now. The Fed doesn't start actually easing policy until they start cutting by more than 100 basis points, given that inflation is already starting to come down. So the decline in interest rates is consistent with a soft landing, because essentially what we're looking at is an expectation that the Fed cuts not because the economy is collapsing and that's negating a soft landing, but just because they're cutting to keep the neutral policy rate somewhat consistent and constant.
So, Jim, you take a look at the US 10-year yield, for instance, at 3-month lows, but are you expecting then that trajectory is likely to continue with easing financial conditions as we head into 2024?
Yeah, so look, I think that the 10-year Treasury, if we have a soft landing, which is what we're expecting, it's going to be difficult for the 10-year Treasury yield to get much below 4%. So I think what's happening right now is the market's actually pulling forward. The market's actually starting to pull forward this expectation that the Fed is going to have to cut interest rates. Again, not because the economy is collapsing or anything like that, but just because they want to keep the level of policy rates consistent with the level of keeping full potential growth and inflation stable. So the movement down to 4% in the 10-year Treasury is really just the markets adjusting for this potential rate cut by the Fed, and the markets have the Fed priced to cut interest rates by a little over 125 basis points next year. And I think that's largely what it is. It's not a reflection of a significant deterioration in the economy. And that's an important point.
So, Jim, how does this set up equity market then? Just as far as, given we've seen that Santa rally very much underway at the moment, can you see continued strength into the new year?
Yeah, I'm glad you asked that question, because this is really positive for equity markets. Because if you think about this, right, what we're saying is that we're likely to have a softer landing, but at the same time, the Fed is also likely to cut interest rates, which means that the discount factor on all of these cash flows from equity earnings and things like that is just worth more money. So the present value of equities goes up. And that's one of the reasons why I think we've seen such a strong, market move within equities over the past several weeks. It's because interest rates are likely to come lower. So this is actually very positive for equities. But I'll also have to say, just like I was talking about the 10-year Treasury yield, that everything is being pulled forward, that this may be about where equities are supposed to go. Maybe they can go a little bit higher, but it would take a different catalyst to push them higher, not just the adjustment in interest rates, because this has already happened. Now this is old news. We need a new catalyst to bring equities higher, and that would have to be better economic data, better earnings, things like that, and that's yet to be determined for 2024.
Yeah, what are you seeing at the moment? Obviously, the first half of this year is very much driven by the Magnificent Seven. We saw those mega cap tech stocks driving the market. It was narrow. Much broader now in terms of what we're seeing on the US equity market.
Yeah, exactly. And look, I don't like to make forecasts, but if I were to make a forecast, my forecast would be that the broader market will outperform the narrow market in 2024. And all it would really take is a modest correction in these Magnificent Seven, as we like to call them, and that this could actually mean that if we have a soft landing, if we have reasonable growth, that the growth is cooling, not collapsing, earnings growth is still positive, that the broader market is likely to participate. Because like you said, the first half of this year, of 2023, we saw 2 consecutive quarters, first quarter and second quarter, of negative earnings growth. That's an earnings recession. That's behind us now. So now as we start to look forward, I would think that people are going to start to place a higher value on the other 493 stocks, not just the 7, but the other 493 in the S&P 500, where the PE multiple, if I look at the equal weighted S&P 500, is closer to a normal valuation or an average valuation, somewhere around 16 and a half. So if interest rates are coming down, we don't have a collapse in the economy, I would argue that the broader market is actually poised to do better. And that means that the broader market could actually outperform the index. The index levels could struggle a bit in 2024, but I think if you have a balanced portfolio that includes value, growth, fixed income equities, a nice balanced portfolio that's very broad, that could actually do better than just those Magnificent Seven.
Yeah, in fact, I'm just looking at the latest research, Jim, looking at that rotation we're underway at the moment, where retail interest shifting from cash funds and those Magnificent Seven stocks into smaller cap names.
Yeah, so, and that's exactly right. And that's a really good indicator, because small caps tend to be a very high beta, very cyclical part of the markets. So the fact that these small caps are starting to participate in this movement higher means that the larger community of investors is now starting to broaden out their view of what a collapsing economy might actually do for the broader equity markets. And small caps tend to be very cyclical, very high beta, so we got to be a little bit careful sometimes. But certainly small cap participation and even mid cap participation is actually a really good sign that the markets could start to broaden. But like I said, it could be volatile, so we have to be a little bit careful and be a little bit sure. But it could be an early sign that this broadening is already starting to happen.
So Jim, overall, how well placed is the investor at the beginning of 2024 compared with 12 months ago?
Well, I think from a bond perspective, the good news is that the starting yields are a lot higher now than what they were to start 2023. So that means that bond investors have more protection or a better hedge against rising interest rates, that their return profile is better because just yields are just higher. So they have more of a cushion against rates rising a bit more. From an equity perspective, though, what we tend to see with the flows is that people are still underweight equities. They still have a high level of cash. I don't think they're fully invested in the equity markets at this point. I'd say that technically people are probably a little bit more invested in equities right now than what they were at the start of 2023. but I still think that they're relatively underweight. So equities still have a pretty good technical underpinning from a cash and from a flow perspective of if equity markets continue to move higher, people are going to be dragged in and they might even start to chase the rally a little bit. The equity market is not overowned, by any stretch of the imagination. So higher prices in a really weird way hurt those who are underinvested in the equity markets right now because they don't get to participate in the rally, and the risk is that they get dragged in at much higher levels, which if there's a downturn, they'll also be quick to liquidate too, and that could cause some pain.
Well, Jim, of course, diversification in a portfolio is always recommended, but how can investors best manage both the risks and the opportunities at the moment?
So the answer to that question used to be really easy. For 40 years, it was a really easy answer. From 1981 to 2021, it was a really easy answer because the bond market was in a 40-year bull market. And in the US, we had 36 out of 40 years had positive returns in bonds. Bonds were a natural hedge to equities for a period of about 40 years. Today, with the interest rate cycle, maybe moving sideways at a higher level, bonds are not the hedge that they once were, but they still do represent a safe haven place to put your money. So what I would argue is that now, today, you just can't passively sit in fixed income portfolios. You've got to be a bit more active with both your equity allocation and your fixed income allocation. So really what we're trying to say and what we're trying to do is we're trying to figure out the right portfolio balance. Is it 60-40? Is it 70-30? It's not always 60-40, right? It could be 40-60 sometimes. And that's the kind of active management that we need to incorporate in order to reduce the correlation risks between fixed income and equity in a broader portfolio in order to achieve the diversification characteristics that we want. So this is our age question right now. This is what we have to figure out, all of us. And this is essentially what's going to make the markets a bit challenging because we just can't sit in 40% fixed income and have it do its job. We got to be a little bit more nimble and a little bit more active.
Jim Caron from Morgan Stanley. All right, the open just a couple of minutes away. We are expecting slightly lower open when we get underway. Bear with us for just a moment.